Repo madness is under control. So the New York Fed and other people at the Federal Reserve, Jerome Powell in his congressional testimony, other Federal Reserve Board of Governors have been saying how repo madness is under control. And today I was just planning on doing a Fed balance sheet update because normally we get them on Thursdays now. And the Federal Reserve balance sheet's up around their official balance sheets up around $8 billion from last week, bringing the total to around $80 billion of official balance sheet increases in just the last 3 weeks. And yes, that is a big number. Over the last 5 weeks, the Fed's official balance sheet is up $100 billion. The amount of U.S. Treasury purchases the Fed has done in the last 2.5 months since the end of August has increased by $120.829 billion. However, about an hour ago, a little less than an hour ago, we got a press release out. The Federal Reserve has announced that there are new repo madness. So, not only is there 14-day term repos that these repos were not supposed to add to the Fed balance sheet. They told us that the balance sheet would not increase, that these 14-day term repos would roll off. They would be rolled off. And instead, we've seen a lot of evidence that they're the opposite. We now have, according to this new Fed press release that came out less than an hour ago, there is now 28-day term repos and 42-day term repos. So, you have 14-day term repos, 28-day term repos, and 42-day term repos. This will transition things to permanent repos. They're conditioning everyone, like Pavlovian dogs, to expect that these repos will not roll off. And most people are going to forget everything that the Fed said only a month or two ago. So let me read the press release that came out. It's a Reuters press release that came out at 4:42 p.m. Eastern Time. I haven't seen anyone else talk about it. I spent last 30 minutes looking for it on the New York Fed. It's not even on the New York Fed website. If it's there, it's buried. It's not on a main article. I was looking all over the New York Fed website. I had to find it in a Reuters article, combing through it. So here we go. The article is Update 2. Fed's T-bill purchases to stay at $60 billion for next month. The Federal Reserve Bank of New York on Thursday said it will purchase $60 billion in short-term Treasury bills through middle of December, keeping up the same pace for the balance sheet expansion program it launched last month in an effort to shore up liquidity in money markets. So this is not the main part of the story. Here we go. The New York Fed also said, and this is the real interesting part, it will introduce longer-term operations in the market for repurchase agreements or repo, giving firms a chance to borrow cash through the end of the year when investors and officials fear that money market volatility will rise again. The central bank will now offer a total of $55 billion for longer-term repos in each one of the longer-term repos. 2 operations lasting 42 days will take place on November 25th and December 2nd. And I have a feeling there with the clown show, and that's why I used the clown emojis, because it's a clown show now. And then I used puke green for the repo madness, because this is making me sick to my stomach about the people in power changing the rules and moving the goalposts. So they're making it's only 2 term repos. Well, when repo madness officially became public on September 17th. We started hearing about it on September 16th. The article started coming out September 17th, along with all these the official press release from the Federal Reserve and all these articles. And initially, it was $35 billion in overnight repos, which is what China, I think, is doing right now. And the Fed made it it's only $35 billion. And then within a couple weeks, it was up to $75 billion. And then within less than a month after that, it was up to at least $120 billion. So here we are, only about 2 months since September 17th, a little under 2 months, almost there though, and we're already at least $120 billion. And in a speech on November 4th, a senior vice president at the New York Federal Reserve, which I covered, she admitted that repo madness averages 190 billion per day, and they're claiming that the repo market is under control, that things are fine. Jerome Powell just gave congressional testimony saying things are fine. Then why are we going to 28-day term repos now too, adding those, and 42-day term repos? No, 42-day term repo means that they're going to increase the balance sheets. I don't know how they can say with a straight face that they're gonna do a 42-day term repo and not increase the balance sheet. I mean, they're monetizing the debt. Rob says, watch this hand over here while I reach into your pocket. Yep. Well, the Fed needs to monetize the debt. They've talked about fiscal policy. The budget deficits from both political parties in Congress are too much. If there's this many term repos, there's definitely problems with a large bank, in my opinion. Yes, also, I was going to talk about that too. GATA, Gold Antitrust Action Committee, Chris Powell tried to get a response from the New York Fed. I was going to read that here. So let me see if there's any more stuff mentioned. Articles. The end goal is to bring reserves back to 1.5 trillion, the level seen in mid-September before quantitative tightening finished. So they're trying to get the quantitative tightening program almost broke things. They couldn't even take a couple $100 billion, or not even 20%, I think, off the Fed's official balance sheet. The interest rate hikes and the quantitative tightening almost broke things. The Fed is also, I haven't checked the yield curve in the last couple days, but the Fed is also, through brute force with the rate cuts, uninverted the yield curve. I'll talk about that on a separate show. Crazy, huh? Okay, so the Freedom of Information Act request, the story came out yesterday from Chris Powell of Gold Antitrust Action Committee, or GATA. If you want to know which investment houses or banks have been getting the infamous repo loans from the Federal Reserve Bank of New York in recent weeks, as GATA has wanted to know, you have to wait 2 years, according to a letter received from the bank today in response to GATA's request for the information. And honestly, I don't think they're going to reveal it in 2 years. But we may find out sooner. I have a theory about this because there's a hedge fund and banking analyst who's been writing articles, Christopher Whalen. I'll put a link in there. He's been going through Citibank's balance sheet, and they've been having a lot of problems. He's been talking about how Citibank needs to be taken over by another bank. So it could be Citibank. It seems like Citibank's having a lot of problems. I'll put the article in the information and description section. I won't read that article right now. So let me just continue with this GATA article. The delay, the New York Fed's letter says, is authorized by the Dodd-Frank Wall Street Reform and Consumer Protection. So how is the delay in freedom of information, how is that protecting consumers? How are you getting protected from knowing that the bank you have your checking account or savings account or small business account at is not safe? We'll need a bailout or a takeover, or could be on its way to, has a derivatives fire, over-the-counter derivative fire, has some type of large problem, and is tapping the repo market in disproportionate amounts to save itself, to delay the inevitable, perhaps. Yeah, so they're claiming that the Consumer Protection Act, Dodd-Frank Wall Street Reform and Consumer Protection Act, is why they can deny a Freedom of Information Act request. It's not protecting consumers at all. This lack of transparency is not protecting consumers at all. Perhaps more interesting, it's like the Patriot Act, saying that the Patriot Act does the exact opposite of what it says in public. It doesn't promote freedom at all. It's one of those government programs that's Orwellian worded. Perhaps more interestingly, New York Fed's letter signed by Corporate Secretary Sean Elizabeth Phillips. Okay, I won't make a joke about that person's name. because Sean is also a woman's name, but if it's a guy, he has a woman's middle name. Anyway, contends that the bank is exempt from the Federal Freedom of Information Act, but tries to comply with its spirit. Such a claim of exemption was not made by the Federal Reserve's Board of Governors during GATA's FOIA lawsuit against it in 2011, in which GATA sought access to the board's gold-related documents. GATA technically won the case when U.S. District Judge Ellen Segal Hovell ruled that one such document was illegally withheld and ordered the board to disclose it to GATA and pay the organization court fees of $2,670. What kind of system of government is it when every week an entity created by ordinary legislation can create enormous amounts of a nation's currency and disperse it to unidentified parties without any oversight by the people's elected representatives, news organizations, not that the mainstream financial media wants to know which bank is in trouble, and ordinary citizens? It sure doesn't sound like the land of the free and home of the brave. Okay, and the rest is just a copy of the letter that GATA received from the Fed. I'll just go on the record here. I'm going to be very surprised if officially the Fed actually, in a Freedom of Information Act or FOIA request, if GATA actually gets that information even in 2 years. They'll probably just drag it out. Yeah, it really is a clown show. So this is transitioning to permanent repo facility. They are conditioning us like Pavlovian dogs. So we've gone from, initially it was just overnight repo, and all these people are calling me names saying, it's only overnight repo, you don't understand anything about the repo market. Okay, it's overnight, but the thing to watch about the repo market is the size of amount of drawn on the repos. That's the red flag. So when you go from 100 billion or less per month in the repos, all of a sudden you're over at least 120 billion per day. And then the monthly totals are just insane. So the red flags are when the size of the overnight repo market goes, it more than doubles, it triples, it quadruples or higher. That's the red flags. The terms are getting longer because the banks probably cannot afford to repurchase the stuff that is being bought. And the Fed is conditioning us for a permanent repo facility, which the Fed had. The Fed had a market manipulation permanent repo facility many years ago before they started the QE programs. The Fed ditched the permanent repo facility before they started QE1. So Wolf Richter did a podcast of wolfstreet.com. He did a podcast on this in the last couple weeks and talked about repo. So they are conditioning us that most people aren't going to be aware that initially repo went from just overnight and then, okay, now there's 14-day term limits for separate repo programs. And, oh, don't worry, those 14-day term repos are going to roll off. They're not going to be added to the balance sheet. It's no big deal. It's only 14 days. Short-term, another short-term loan instead of overnight, only 14 days. Well, the Fed's balance sheet has increased by, let me look up the number, $287,936,000,000 since the end of August, since the quantitative tightening program ended. So the balance, even though the not QE program or not QE program is only $60 billion a month. So we're not even a full month into the not QE program, which is only supposed to be $60 billion a month in treasuries, and already the Fed's balance sheet has expanded by almost $300 billion since the end of August. And we're not even 3 months past the end of August. Welcome to dystopia. Truly is repo madness. Even Bloomberg's using repo madness now. Not giving me credit for it, by the way. I even heard on a Bloomberg podcast a friend sent me, a friend on Twitter. And supposedly this investment banker who's the best repo expert and has been writing about repo for years, he did a podcast interview, this guy named Zoltan. He's like really high up in this investment bank. I have the link to the podcast. I listened to like the 17-minute interview, and he was all over the, like, supposedly he's a really, really smart guy, knows a lot about repo, supposedly more than anyone than any other investment banker about the repo markets, and he was all over the place. Like, he was speculating, he was talking about a bunch of different theories, he didn't even, in my opinion, he didn't even seem to know what the hell he was talking about. Because he was talking about the banks. First of all, it was a government regulation that was causing the banks. They couldn't lend out because of reserve ratios that were mandated after 2008. They couldn't lend out the overnight money in repo. And then he was talking about the end of the quarter shortages from corporate taxes. He was talking about all these different theories together. And I don't think it's the corporate tax shortages. I think there's seriously some type of larger problem in the repo market. So we're being conditioned to these longer term repos now, and they're telling us, don't worry, it's only 14 days, and it'll roll off the Fed's balance sheet. Don't worry, it's only 28 days. Don't worry, it's only 42 days. And then before we know it, permanent repo facility. Then before we know it, this not QE program is going to go from $60 billion per month. And Jim Bianco has been saying now for weeks that the Fed has tried to drug into submission the repo market with the total amount offered of repos. And he said it hasn't fixed any problems, and that this drugging of the repo market will eventually turn into many, many hundreds of billions of dollars in QE. So we're going to go a lot higher, probably in less than 6 months, from officially $60 billion of not QE to a lot more than $60 billion of not QE. Okay, let me take a look at my super chat questions. Thank you, Greg, for the super chat. Greek Freak says, been reading Fed will bring down the economy before the election and that Trump was always planned to be a complicit scapegoat. Do I agree? No, I don't agree. I've been saying for really since Trump won the election and he was criticizing the Federal Reserve that the Fed could crash the stock market to get rid of Trump. But Trump was initially, when Janet Yellen was in power there, he was kissing her butt, and then he replaced Janet Yellen with Powell. And initially he got along with Powell, but then the rate increases, the rate hikes really pissed Trump off, and the last rate hike put Trump into a frenzy. December 2018, that was the last straw. So I don't know if the Fed wants to fully crash everything. The Fed is totally worried. The Fed is doing tons of things that contradict themselves. I was going to do a separate show on this. So in February, Lael Brainerd was talking about how the Fed didn't care if they inverted the yield curve. They said it wasn't a big deal. She said it wasn't a big deal. Go back and look it up. I did shows on this. There's articles. She said they didn't care. And now I think it's very obvious with the Fed rate cuts, not only were they trying to weaken the dollar, they didn't want the dollar rally continuing, they were trying to, with brute force, not only do you have the Fed in a currency war and trade war with the European Union and China, and beggar thy neighbor policy, same mistakes of the 1920s and 30s being repeated, but the Fed was also with brute force, with the rate cuts, one of the major goals, besides trying to prevent the dollar from rallying, was also to uninvert the yield curve. So no, I don't think everyone at the Fed wants to crash the stock market for Trump. There are some. There was the former New York Fed president who worked at Goldman Sachs, Bill Dudley. He talked about that a couple months ago, 2 or 3 months ago, and then he had to backtrack that because he looked really bad in public. So I think there's a lot of infighting. There's a lot of panic, chaos, confusion, infighting at the Fed. Yeah, I don't like how Trump is saying he wants negative interest rates. That would be a lot more inflation. And here we are at stock market. The Dow's almost at 28,000. The S&P 500 is at all-time highs. The national debt's over 23 trillion. So yes, I think there are people inside the Fed that want to crash the stock market, and I think there's also people inside the Fed that don't. I think there's a lot of fighting inside the Fed. I know there's conspiracy theorists out there that disagree with me, but from public comments and research papers that I put together, there's a lot of infighting in the Fed They are really confused about what to do. They are transitioning us to set up a permanent repo facility. It's going to be at least, from the research papers, and I talked about this in past Repo Madness podcasts, the permanent repo facility will be at least $300 billion. So these longer term repos are transitioning us to permanent repo. I think Trump was initially on board with some of the interest rate increases, but he didn't realize how bad the bond market was. Those interest rate hikes, because of how much corporate America has borrowed, almost broke the bond market and the junk bond market. Corporate bond market, junk bond market. Okay, so the repos are supposed, Tom asks, are these repos being rolled over? So the repos are, the Fed was telling us when they instituted the 14-day term repos, because initially the repos were only overnight. It was like $35 billion only overnight. Everyone was like, the money, the stuff will be repurchased the next day. It's only overnight loans, no big deal. And then the 14-day term repos. And they're supposed to roll off. Okay? They're not supposed to be rolled over. But they are being rolled over. And some of these things may be rolled over in perpetuity. The Fed has claimed that they only accept quote-unquote good collateral for the repos. And the Fed has defined good collateral as U.S. Treasuries, agency debt, and now mortgage-backed securities. I personally would not call mortgage-backed securities as good collateral. In fact, I think most of these banks don't want to repurchase mortgage-backed securities. They want to dump them on the Fed. We would need an audit, an independent audit, to know what the Fed is actually taking as collateral. I have asked a lot of experts about this, and the other people have guesses, but no one knows without an audit what's really being accepted as collateral. The banks don't have to. The banks count repo short term. Why report earnings? The banks don't count repo as long-term stuff. It's counted as short-term. And the Fed does not want anyone knowing which banks are borrowing the most in a repo. Because if within a couple weeks, then that bank, the shares could be down more than 50% if it got out. So to me, it looks like a lot of these term repos are going to be rolled over rolled over in perpetuity until the Fed transitions to larger, not QE. And we are told that these term repos would roll off after 14 days. We are told they're only 14 days. After 14 days, they're gone. They're not going to be added permanently to the Fed's balance sheet. That's what we were told. And here we are about 2 months later, because I think the term repos were announced. I don't remember if they were, because this was a couple months ago. I don't remember if the 14-day term repos were announced exactly in the press release on September 17th, but they were announced, I think, maybe about at most like a week after the first official Repo Madness announcement. So we were told that the 14-day term repos would roll off. They wouldn't be added to the Fed's balance sheet, no worries. And here we are now. The evidence has shown that on the Fed's official balance sheet, a lot of these 14-day term repos have not rolled off. And now there's even more term repos. Oh, and they increased the amount of 14-day term repos too. So they increased the amount of 14-day term repos offered and the size of them. I think it was a smaller amount of the 14-day. It was maybe like 20 billion or something, or 30 billion, and then it's higher than 30 billion. China's doing Repo Madness too. It is smaller though. I think China is like 35 billion per day. The People's Bank of China. So China's doing repo madness too. How do you profit off of this? This is what the Fed doesn't want. The Fed doesn't want anyone knowing which bank it is, or which bank or two banks or three banks it is. Because then the market would figure out the shares of that bank are going to drop 50%, and then the other banks, the largest banks that have the bad bank as counterparties, those banks are going to be in trouble. The Fed doesn't want that, because then you're looking at Bear Stearns and Lehman Brothers 2.0. So that's why the Fed doesn't want transparency here, because once someone figures out with concrete proof which bank or two or three it is, then the dominoes are going to start falling. So that 2-year Freedom of Information Act request, I don't think they're going to get that data in 2 years. But we may find out through a whistleblower or some other piece of information sooner than that. But I don't think the Fed's going to comply with the FOIA request in 2 years. Hey, Todd, I don't remember your question, man. I get literally dozens and dozens of questions, so I can't remember everything. And if I remember correctly, normally you're pretty rude. I don't remember that specific question, but normally your comments, you're pretty rude. Officially, the New York Fed claims that they will comply with Freedom of Information Act requests, but unofficially, they, like every other, they're not a full government agency. You know how the Fed like treads on the gray line there between public and private. They jump across the line on either side whenever they need to. But, you know, because a lot of the government agencies don't fully comply. Have you heard that, like, sometimes these FOIA requests, it takes years, and then these government agencies will intentionally, with a black Sharpie, they'll leave 2 words that aren't marked out in all black Sharpie to a FOIA request. Yesterday on the Carrie Lutz podcast, Martin Armstrong said Repo Madness is about bailing out Deutsche Bank derivatives, and Deutsche Bank has already failed. And anyway, Todd, I've been talking about China has been doing repo for at least a couple weeks, so you don't know what you're talking about, bro. Your memory's a little sketch. China's doing all kinds of liquidity programs and bailouts. Grim repo. No, Powell didn't say this today. This was a separate New York Federal Reserve announcement on their schedule, updating the not QE program, that it's staying at $60 billion per month in U.S. Treasury purchases, and also announcing the new term repos. I have the link. Here we go. Let me get it's a Reuters article. I'll put it in the live chat. Yeah, I mean, if you're not familiar with what these government agencies normally do to FOIA requests, they delay them for years. Go and listen to what Tom Fitton and the Judicial Watch people have had to do to get FOIA requests. And when they do a FOIA request, sometimes they'll get pages and pages of documents where everything's blacked out in Sharpie. And then the government agency will say, see, we complied with the request. And there's like 2 words you can read. No, I don't see a coincidence with Saudi Aramco IPO and Repo Madness. Norman says in 2 years it won't make a difference with the Freedom of Information Act request, I completely agree with him. I think 2 years from now we will know, we will have a really good idea which bank or banks are in trouble. Probably less than 2 years. Actually, repo, short for repurchase agreement, the banks are supposed to buy all the stuff back, but we don't know without transparent independent audits if the banks are actually buying all the stuff back. And in fact, the Fed's official balance sheet says that the banks are not buying all the stuff back because the not QE program has only been online for less than a month. I think it's a month tomorrow because it was announced October 15th. That's only $60 billion a month. And then here we are since the end of August, the Federal Reserve's balance sheet, I did the math before we got on here, it's up $288 billion approximately. So probably next week or the week after, the Fed's balance sheet will be officially up over $300 billion since the end of August. I may have to do, I've been monitoring some of the stories about the Farmageddon stuff. I may have to do another show on it. I don't want to mix shows. I have to keep the topics. I want to try to keep a lot of the topics the same on each show. I don't want to go mixing shows. Thank you for the super chat, Justin. I appreciate it. Woolali says they keep changing the goalposts like they always do. Exactly. And I'm one of the few people in the gold community and the alternative media that keeps bringing this up. So these term repos changing, the term repos changing in size, in length and size. So initially the 14-day term repos were smaller. They increased the amount of 14-day term repos offered. They increased the size of the 14-day term repos offered. Here we are now at 28-day term repos, 2. They're not going to, I don't think they're going to take away the 14-day ones. They're still going to offer them. It doesn't say in the press release they're getting rid of the 14-day term repos. It just says they're adding. So the longer term repos are now 55 billion. Now, I think the better way to look at the 42-day repo, Rob, rather than a treasury bond, is to say that the Fed is bailing out bank balance sheets. Now, if they're just taking U.S. Treasuries as collateral, that's much better collateral than mortgage-backed securities or agency debt, in my opinion. They could also be taking even worse stuff than mortgage-backed securities, but we would not know that without an audit, a real audit. Because we're seeing articles that are coming out that there's really, really bad problems in leveraged loans. The leveraged loan market's really starting to sputter, and collateralized loan obligation markets are sputtering too. And that was the most toxic things I've looked at in a long time are the CLOs, collateralized loan obligations. The largest banks are the main members of the Fed. The largest banks have all the control. So your JP Morgans, your Bank of Americas, your Wells Fargos, your Citigroups. The large banks have... The small banks don't get all the perks that the large banks do. I have an Ethereum wallet, Squarecracker. It's listed in the information and description section under every single video. I have a wallet for Bitcoin. I take 6 cryptocurrency tips. Bitcoin, Litecoin, Ethereum. This is a good question from Dirty Bubble Rising. Would I say these repos are evidence that one or more U.S. banks have already failed? I don't know if the banks have failed, but they're close to failing. So I don't know if one bank has already failed. I've heard there's been rumors going around that Deutsche Bank has failed, but no one's produced any credible evidence showing that they have yet. So there's been rumors now for the last 2 weeks or so, but I haven't seen any proof of that. I think it's fair to say that there's, with the repo stuff, there's evidence that one or more US or European banks is close to failing. That's what I think it's fair to say that, in my opinion. Finance Freak says basically they said they wouldn't cut in December, so they need something else to boost the markets. Well, they don't need to cut because let me look at the dollar index real quick. Dollar index is hovering above 98 at 98.17. So the two main reasons, in my opinion, why they cut rates so much, despite the economy still expanding technically with the official fake government numbers, is they wanted to try to weaken the dollar because the dollar was above 99 on the dollar index, and that was starting to panic them with how much dollar-denominated debt, and they wanted to try to weaken the dollar relative to the other currencies. And then also they wanted to uninvert the yield curve, because in an inverted yield curve, they started to panic about that. After Lael Brainerd said in February, earlier this year, they didn't care. So they've uninverted. I'll have to look up the exact yield curve amounts, but when I checked it a few days ago, the yield curve was uninverted. So those rate cuts were done rapidly on the front end of the curve to uninvert the yield curve. Could it be Bank of America? I'll put this article here in the live chat now, but it'll also be in the information and description section. This analyst lays out he thinks it's Citibank. This analyst, he is a very well-respected hedge fund, institutional level bank analyst. He goes through all the footnotes, all the financial statements of the banks, and he thinks that it's Citigroup. He thinks Citigroup needs to be bailed out or taken over soon. I mean, this is the problem with all these banks are all too big. They have too many derivatives. They're all too big. So if there's one problem with one of the banks, well, these other large banks all have counterparty risk. And this is why financial professionals, even though the paper gold prices dropped in US dollars, dropped $100 in the last month or so, this is why financial professionals who are seeing this repo madness and all the other crazy things these central banks are doing, a lot of these guys are starting to wake up and they're starting to buy physical gold on dips. Because they're looking at all the problems and saying, you know what, in the next year or 2 or 3, one of these things is going to break. Could be China, could be emerging markets, could be corporate bonds. Oh, thank you for the super chat, Norman. Okay, so I think I've covered this enough. If you didn't hear all the stuff about repo madness, they're conditioning us, in my opinion, for a permanent repo facility. It's going to be hundreds of billions of dollars, and then the not QE program is going to expand a lot more than 60 billion per month. That's not my opinion doing that. Well, I think it is my opinion, but also Jim Bianco is saying that too. And Jim Bianco spends a lot of his time tracking the repo madness stuff. He's a global macro newsletter writer. You can follow him on Twitter. He just put out some really good new charts and graphs on his Twitter. Orwell and Good says the CLO is the herpes of finance. I would say they're more toxic than that. Okay, so just an even worse clown. Repo madness, it is not fixed. They're making it bigger. Okay, averaging 190 billion per day, not fixing things. It's like what Jim Bianco says. They're trying to drug the problem into submission, But if a bank has trillions of dollars in bad derivatives, or over $1 trillion in bad exposure to these collateralized loan obligations or other problems of that magnitude, the repo madness isn't going to fix things. Liquidity doesn't fix solvency, excuse me. So that's it for right now. I want to thank my almost 200 Patreon account contributors. You're giving me a lot. You're allowing me to grow my small business and give me a lot less stress in my life. Focus on content like this and finding stories ahead of the curve. I didn't even see that Zero Hedge covered that there's new term repos out. So there are new term repos added. I did not see in the press release that the 14-day term repos are done. So my educated guess is the 14-day term repos will stay. The larger size 14-day term repos, there's more of them offered. And now we're going to longer duration term repos, and that will transition to the permanent repo facility and larger, not QE. Also, thank you to my dozen or so monthly PayPal contributors and the people throwing me tip once in a while. I've been saying this, I guess people didn't read this. A lot of people don't read the information and description section under each YouTube video. There's a lot of sources cited. There's articles, there's other videos, there's research reports, there's sources under the video. So the article talking about the press release here, about the size of the new repo terms, that will be under the video, along with the letter that GATA, Gold Antitrust Action Committee, received, a link to that from the New York Federal Reserve on their FOIA request. Anthony, I've talked about, before I wrap up the show, I'll just answer this question quick. Politicians have considered taking people's pensions. Do I think it will come to that? They can't do it right away. So the corporations like General Electric and others are out of desperation. First of all, General Electric should not have put so much of the employee pension into General Electric stock. That was just ridiculous. And now General Electric's going after 20,000 employees' pensions because they're in trouble. General Electric's been doing accounting fraud for many, many years. But politicians can't go after the pensions all right away. It has to be done slowly. So what I think will happen, I've been talking about this for years, Jim Rogers has also said something similar, that what will happen initially is they will ask people in their 401k or IRA retirement accounts or government employee retirement accounts that like 1% or 2% will be required to buy U.S. Treasuries or infrastructure bonds or something along those magnitude. So you will be required for your retirement to fund government deficits or infrastructure bonds or something along those lines. And it will start off small, but it will be like incrementalism and the camel getting its nose under the tent. And remember how the income tax, when the income tax was first passed here in the US, it was only supposed to be rich people. So only the rich people were supposed to pay the income tax, and I think it was 8% or 9% was the income tax initially. This was 1913, the income tax was passed right along with the creation of the Federal Reserve. So it was sold that, the voters, they can vote rich people to pay an income tax. And then the income tax changed. So I would view that that's how the politicians would start to go after. There's approximately $19 trillion in retirement savings here for Americans in like 401ks, IRAs, etc. How does what spill over into risk assets, Tarkinas, on the super chat? How does repo madness? It depends on the risk asset. Because if you're talking about gold mining juniors at some point, those might do well with higher gold prices. It depends what the risk asset is. Some rich people pay taxes and some don't. The ones who hire the best tax attorneys and tax accountants don't, unless they want to voluntarily pay. There are some rich people who want to voluntarily pay higher taxes. It depends. Yeah, but initially, Annika, the income tax was sold to the voters, that the voters would only be voting for taxing the rich. It's how it's sold initially to the voters, and then the rules change. The goalposts are moved. This is classic how large governments work. I'm not sure which Tarkinas, I'm not sure which, thank you for the super chat, I'm not sure which risk assets you mean. I think it would depend on different, you can't make a blank statement for all the risk assets, like, oh, all these risk assets are going to do this. I think it's going to be individual stuff. It's going to depend, it's going to depend on a case-by-case basis. Which risk assets? Because if the gold price goes to 2,000, then junior mining stocks are going to do very well. If the gold price continues to correct and goes back down to 1,400 temporarily in US dollars, junior mining stocks will do very, very badly. As of now, Tarkinas, it looks like the stock market is continuing, the US stock market is going up and capital is going into there. However, I was going to talk about this on a separate show. When the yield curve goes from inverted to uninverting, that normally the correlation is bad for stocks within about 12 months. Normally, at least in the past. Johnny, I think that's intentionally by YouTube. That's why I've added all of 100 new subscribers in the last two plus months. You got to check back every day. It's intentional. And yes, long-time subscribe. It's not people listen once in a while who are being unsubscribed from my channel or not getting notifications. I'm getting emails from people that listen to videos every day that are being unsubscribed from my channel. I mean, I should already have like over 50,000 subscribers, but I can't control. I have no control over that. All I have control over is this content. I just focus on process and making the best content possible, and everything else will take care of itself. But that's why my Patreon and my PayPal are so important, because we're less than a year away from the election, and who knows all the crazy stuff that could happen. What happened right before the 2016 election is I actually had tons and tons of subscribers removed. I was getting like, at one point I was getting hundreds of subscribers removed from my channel per week. Prior to the 2016 election, the closer it got, the more censored my channel got. And then I would say within about 6 to 8 months after, then the censorship toned down. Saying goes, nothing is as permanent as a temporary tax. Also, nothing is as permanent as a temporary government program. One of the few quotes I actually agree with Milton Friedman on. Isn't Twitch for video game players? I think I could integrate Vimeo live streams behind the paywall on Patreon. Tarkinas, you might want to go back and listen to the show. I already explained that. Thank you for the super chat again. I appreciate it, though. I already explained this at the beginning. So I think what will happen with Repo Madness is it will get larger and larger, and then it will transition. We're being conditioned like Pavlovian dogs, that the Fed has it under control. It's not a big deal. They keep repeating this, that everything's fine. Jerome Powell said this in his testimony at Congress. And eventually this goes to, in my opinion, a permanent repo facility, which is what the Fed had before they started QE1 many years ago, and then larger, much larger, not QE programs per month. So we go from 60 billion per month, not QE, let's say to over 100 billion per month or more. Look, the Fed's balance sheet is already increasing. Just since the end of August, the Fed's balance sheet's almost on 100 billion per month pace. Let's see what it is at the end of November, but the pace that the Fed's balance sheet is increasing on is already on over 100 billion per month. We're on a 100 billion plus per month pace already per month of balance sheet increases by the Fed. So whether that's repo madness that the banks are not repurchasing. That is not 14-day term repos that are not rolling off or not QE. The balance sheet is the Fed's official balance sheet is increasing a lot. It's probably even larger than that, but we wouldn't know that unofficially without a real transparent independent audit. Okay, my voice is starting to go. That's it for right now. I will work on more content for the rest of the week. I have some other good ideas about content coming, but you heard it here first. The term repos are now not only 14 days, so those have increased in the amount of total number of 14-day term repos offered and the size of them, but now we have 28-day term repos and 42-day term repos.